do as far as my credit is concerned. Is credit the only thing that's looked at, my credit score, when it comes to getting a pre-approval letter? You know, things like that. So those are some of the questions that we've been receiving. And I wanted to come to you today just to give you a little bit of insight into, you know, our professional experience and really what items are being considered when it comes to getting you a pre-approval letter or getting you pre-approved for a loan. So the first thing that is considered is your credit score. So you may have Credit Karma downloaded on your phone and you look at your credit score and you're like, wow, you know, I'm doing pretty good. Well, what lenders tend to do, you have 3 credit scores from the 3 different credit bureaus. And so what the lenders tend to do, they take the middle number of your 3 numbers. So say, for example, if you have 750 from one credit bureau, you have a 725 and you have a 780 from another. Well, 750 is the credit score that that lender is going to account for in your profile, okay? So that's one thing. The next thing is your payment history. Typically, lenders, you know, they don't want to lend to a potential buyer who has had a late payment within the last 12 months. So if you've had a late payment, let's say it was last December, last August, well, right now we're in April, from whenever that last late payment was, whether it was your car note, you know, a loan that you have, a credit card payment, whatever that month was, just go ahead and push yourself 12 months out. Now that doesn't mean that, hey, I don't need to call Radiant Real Estate Group until 12 months after that. No, go ahead and give us a call, because there are things that you can be doing in that 12-month time frame. And you may, sometimes we even find lenders are able to waive that requirement when the potential buyer has strong, you know, profiles with their credit, or with the last thing that I'm about to tell you is the debt to income ratio. So we said we need our credit score, our payment history, and now it's our debt to income ratio. So we may have heard this a lot and you're like, okay, well, really, what is that? So your debt to income ratio, you take your monthly income, right? Say if it's $5,000, okay. Now you look at your monthly debt. If you're renting currently, don't account for rent, which is great, right? Because that gives you more money back to go back towards your income. So your monthly debt that we'll be looking at is your car payment, if you have a car payment, your loans, if you have any loans out there, credit cards, if you have any credit cards out there, and yes, your student loans. The good thing about them accounting for your student loans is that they will take 1% of those loans if you are not currently paying on the loan. So if you don't have a current monthly payment for your loan, then okay, we're taking 1% of that and we're using that as your monthly payment. So say, for example, if you are on some kind of payment and your payment is $0 a month, then guess what? That's what's going to be counted, $0 a month. But let's say you're in deferment. Okay, so how does that affect me? You may think, you may ask. Well, if you're in deferment, what the lender will do, so if you owe, let's say your student loan balance is $60,000. So what the lender will do is take 1% of that, which is $600, and count that against you as far as your monthly debt is concerned. So with your car payments, any credit cards you have, any other loans you have, then on top of that is the $600 a month student loan payment, okay? So let's just say all of that totaled up to $2,000, right? Or 2,500. Let's make it easy for me. And let's say all of those totaled up to 2,500. Okay, well, we just said that our monthly income is 5,000. Now our monthly debt is 2,500 or $2,500. So the way that you calculate your debt to income ratio, you take that monthly income and you take your monthly debt and you multiply it by or divide it by your monthly income, right? So in our case, we have your debt to income ratio at 50%, which lenders really want to see under 40%. And now, in the times that we're in now with coronavirus and everything going on, you may want to get it as close to 30% or 35%. Just the lower your debt to income ratio, the better chance you have at getting the loan terms that you want. You may be able to get a pre-approval letter, no questions asked. However, your interest rate may be a little higher. Your the term, like the length of your loan, maybe you can't get a 15-year mortgage and you have to get a 30-year mortgage in order to get this loan. 15-year mortgages are becoming more and more popular nowadays. So things like that is what is really affected when we're looking at those three things: your credit, your payment history, and your debt to income ratio. So guys, that's our tip today. Our tip is really, going ahead and looking up what you have. Pull your credit reports. You get a free credit report from each borough per year. One free credit report per year. So go ahead and pull those for yourself and just see where you are. Sit down and really see, where am I? And oftentimes when we do that, we'll see a lot of waste in our budget. Sometimes we don't have a budget, sometimes we do. But we will see a lot of waste. So one of the things to do is, I know the three things that the lender will be looking for when I come to them for pre-approval. If I need to get my debt to income ratio down a bit, maybe I sacrifice eating out or whatever and just put that money that I would have spent there on my credit cards, to getting those credit cards down. Guys, we really hope that helped you, that little bit of information helped you all. And we thank you for tuning in, and we'll see you next week on Mondays. Mondays is our new days for our Radiant Tips of the Week. So we'll see you next Monday. Thank you.